Hello everyone, this is Tabisogunene from Visual Wealth. You can always and you're most welcome to get a hold of me on all the handles that are appearing on your screen right now. Today I want us to talk about the different time frames that a trader has to trade. The different time frames, because a lot of times people let me just say, traders have been asking me, or they do even now ask me, what is the right time frame for us to make money in? Because money is in the correct time frame. If you pick a wrong time frame, you will not make money. If you pick a wrong time frame, you will not make money. That means money is entangled into the correct time frame. Let me just pick an asset here. Let me just take the Euro USD, because I believe most of you people, you have a lot of currency, a lot of forex. So I'm just gonna pick this one that most people are familiar with, the Euro USD. So this is the 15-minute chart, right? So when you are a trader and then you are asking me that what time frame will give me money, or which time frame should I trade, I would simply say to you that, you know what, time frame goes with your risk appetite as an individual trader. It always goes with your risk appetite. And it also goes hand in hand with the size of your account, because the size of your account is directly proportional and it is linked into your risk management, how you manage your risk. Because definitely you cannot be taking large positions if you have got a very tiny account. That is risk management. And you know what? Trading and investing are about analysis. So before you get into the market and you start placing trades or placing positions, it's very important that you get to understand the market you are trading. Get to understand the analytics, the behavior, the psychology behind that particular market that you are trading, or that particular asset that you are trading. Because there is nothing that you can do without you analyzing the market first. And to tell you the honest truth, when you analyze something from the bigger time frame. You analyze an asset from the bigger time frame going down to the smaller time frames. Here we have got the monthly time frame, we've got the weekly time frame, we've got the daily time frame, and then we've got the others, 5 hours, 4 hours, 2 hours, 45, up until down to 1 minute. So if you want to get the clear picture of what is happening with the Euro USD, what has been happening before, and what might transpire in the near future, you have to focus on the larger time frame, because the bigger time frame will articulate the smaller time frames. Because the smaller time frames, the rest of the other time frames, the 1 week, the daily, the 5 hours, going on and on, they are all entangled and they are put together in that month. Because a week makes up a month, days makes up a week, few hours or 24 hours, they make up a day. So that means the lesser, do you understand, is included in the greater, of which is the bigger time frame, the monthly time frame. That is why it will be very much impossible, highly impossible, for you not to understand where the market is planning to go next if you are focusing on the bigger time frames. So now you do your analysis on focusing on the 1 month chart, and then now you can decide based on your on your activity, based on your risk appetite, on your on your personality, because there are different traders in the market. There are aggressive traders. There are those ones who will not mind to take a position. Does not matter where the market might be at a particular time, but when they want to buy, they buy. When they want to sell, they sell. So depending on your personality as a trader. So if you're focusing on the 1 month chart, let me just give you a practical example. When you're focusing on the 1 month chart, the 1 month chart can give us history and shows us the present, and we can use the history and the now to predict prices of the future. It's like an investigation. It's an analysis. We are investigating. When you are doing an investigation, definitely you have to find out the, how can I put it, the history of the person. How, if ever there was a person who has killed someone, you need to find out how were the behavioral patterns of that particular person. How were they? Where were the people? Or where was that person the night of the murder, or whenever it was? It's an investigation. You investigate. Same thing with trading the financial markets. We want the history, because the history can sometimes speak volume, but that is not always accurate. But we can use the history to predict the future. So here, what I'm looking at here, I have got history of the Euro USD since from back in 1978. Those a lot of years back, 1975, from back there. Even my parents are they never knew each other, and I don't know, that is very, very long way back. 1976. I was not there. I believe you were not there too. Maybe some of you were already there, but I believe you were still young. It gives us all this bunch of history with the relative prices here. You see, it's 6, 8, 10, 12, 14, and then it gives us all the way the performance, all the way up until the now. And now, because we have seen the behavior of these pair, now we can now decide and start analyzing on which is the most potential direction that the market will take. So now I want to show you something as well. This is the monthly chart, and it gives us all these years. And now if I decide just to lower it a bit, going into the weekly chart, so do you see that the clumsiness starts coming in? Now flipping it a bit lower into the daily chart. And if you can take a look at the daily chart, yes, there is movement, there is direction in the price here, because the price has been going up, but it does not give you a clearer picture of where this thing is coming from, because it only gives us it's 2016. That means now, if I have to find out what happened to this market in 1980, I really have to do this, I have to do this, and this really looks like a serious fall. But if you go to the monthly chart, you will actually see that this was not that much of a fall. Why does it look like a serious fall? Because you are focusing on a smaller time frame than focusing on the bigger time frame. So what I would advise to you, my traders, focus first on the bigger time frame, and then execute your trades or take your positions based on the smaller time frames. It could be the weekly time frame, it could be the daily time frame. So I wouldn't recommend traders to go lower or lesser up until the 5 hour, 4 hour, 2 hour, 1 minute, 5 minutes, because you know what, there's a lot of activity here and there's a lot of clumsiness, and this is where a lot of people lose their money. A lot of people do not make their money here. That is where they lose their money. Real money is made starting from the daily time frame, weekly time frame, and monthly time frames. I've been telling you that the money of the active always goes to the patient. These are the patient guys here, the whales, the guys with deep pockets. These ones are the quick money guys who think that they can make quick bucks in the market. And these are the guys that use stop losses. These are the guys that do not use stop losses. These are retail traders. These are institutional and money managers and also investors. Let me give you a practical example. Do you really think that, let me give you an example with maybe the Federal Reserve. Do you think that the Federal Reserve can bet and say that they want to buy the market? Let's say maybe they want to buy the euro against the dollar, and they place their buy here at 1.10, and then after they have placed their bet here at 1.10, and then they place a stop loss underneath. Do you really think that banks or large institutions actually do that? No, they do not do that. Why? Because they know that there is where the money is. So their focus is not short term. Their focus is long term, not even medium term, long term. Because they know that even if they bought the market here at 110, let's say they bought the market here and the market slipped below their entry, they still know that they have already injected a lot of money into the market and they bought the euro for it to continue slipping. Because what keeps prices to go up is the flow, the sustainability, and the support that this price is receiving from the money that has been injected by these institutions. So these institutions, they trade and they place their bets knowing that no matter what can happen to this market, it will never go further and go less than 90 or 80 or 70. Why? Because they have already injected billions and billions of dollars somewhere here. So what do retail traders come and do? Because their focus and their sight is only focused on the small time frames. This candle is too much. It is so much big. This is a weekly candle, but if I can break it down and I make it a 5 minute, in the 5 minute time frame, the 15-minute time frame, the 1 hour, I am telling you, is a lot of candles. But here on the weekly, it is only represented by only one candle, only by one candle. So when you trade small time frames, there's too much clumsiness and there is too much detail. But when you focus on the bigger time frames, you get to understand and you get to find out that there is much more clarity and there is much more direction. And definitely you will not make foolish decisions. Why? Because you are able to see the future. You are able to see the end and the beginning. So focus on bigger time frames and then go down with the time frames. Always focus on the bigger time frames and always go down with the time frames. Simple like that. That's when you're going to start making real stash. As from me, I hope this video was very much useful and you are going to start seeing things the way I have explained, and you are going to increase your profitability every time you place your positions. So thank you very much. You are most welcome to subscribe on our channel, and you are even mostly welcome to like this video and share it. Thank you very much. See you on the next video.